welcome to another episode of The Jason Show on my CPE, where we talk about a variety of tax and accounting and practice management topics. And I guess today we kind of roll all of that into one with our guest, Shannon Hay from Live Oak Bank. Hello, Shannon, and welcome.
Thanks, Jason. How are you today? Thanks for having me.
I'm really good. How are you?
Better than I deserve, I always say.
Well, good. I'm glad to hear that. So you are here to talk to us about trends in accounting firm acquisitions. And before we do that, I guess we should set the stage. You are with Live Oak Bank, and you're a bank, but it looks like your bank has a little different story. Why don't you? Yeah. We'll ask about who you are too, but let's start with Live Oak Bank and who Live Oak Bank is.
Yeah, Live Oak Bank is the nation's largest SBA lender by volume. So we do more dollars out the door under the SBA 7A program than any other lender out there. But the reason you may or may not have heard of us is because we are highly verticalized. So we have 35 specialty verticals. We originally started out as a veterinarian-only bank. So jokingly called by the SEC the puppy bank when we were first getting our regs and going public. Went public in 2015 under the NASDAQ at LOB. But the specialty that I focus on is accounting and tax lending, right? And so I only look all day, every day at accounting and tax practices for sale and acquisitions and commercial real estate and the like.
All right, so your title at Live Oak Bank, I'm looking at it right here. You are the VP of Accounting and Tax Lending at Live Oak Bank. So put it plain English, what does the VP of Accounting and Tax Lending do?
Yeah, so all day, every day, I only look at accounting and tax practices or professions. So every borrower that I speak with generally is going to be a CPA, an enrolled agent, or have some ownership in a payroll bookkeeping type practice or business. And my ideal focus, or my sole focus, is I only look at acquisitions or commercial real estate tied to that industry. So what that gives me is a specialty insight for a borrower to help advise them on things I see in the industry trending that can help them in their deal structure and hopefully be highly beneficial. So I'm not confused by looking at one type of business and then trying to assimilate my thinking to a different type of business. I'm only wholly focused on accounting and tax practices.
So these SBA 7A loans, I mean, what is that?
Yeah, so the SBA 7A program is a government guaranteed lending program. And what it does is it is meant to fill a space for banks that didn't exist prior to the SBA program, which has been around for over 50 years. But prior to that, it was, small businesses had a hard time locating capital due to the lack of collateral that they had in their businesses, right? So a lot of these, most businesses are transacted, or most of their value lies in the goodwill of that business, right? And so banks never really recognized that as collateral. But what the SBA did is it kind of allowed this stopgap or filler that says, okay, banks, we recognize it, you do too. However, it's not a repossessable asset, right? So we'll guarantee, the government steps in and guarantees 75% of the loan. That allows banks now to take riskier situations or non-collateralized situations, like, for example, an accounting firm, right? It's highly goodwill, not a lot of equipment or assets. Now even less than ever is there commercial real estate involved in practices. And so it allows, where a bank would normally say that's not a collateralized loan, it now allows us to implement ourselves or give a loan where we normally might not. And that's what the SBA, so the SBA program is really that stopgap or that fill for that 10-year term, single digit rate, no prepayment penalty. There is a SBA guarantee fee that is charged on every SBA loan. That's part of the loan that goes to the government to help fund the program. But it's a outstanding program specifically designed for goodwill acquisitions.
So when you say that this is what you do all day, every day, like how many of these deals are you doing or facilitating in a year?
Yeah. So last year we did 70 million. And that was probably about 70 or so transactions as well. So average deal size being about $1 million. And we do loans as low as 250,000 all the way up to 7.5 million, right? So there's obviously a large variance there. This year we've done, we're at 40 million so far. We hope to do about 100 million. We're really coming into like the height of what we call our selling season, where you see a lot of acquisitions taking place in the accounting world. Right.
So we have a lot of roads that we can go down because you and I have spoken, offline about other things before and kind of outlined some of this podcast in a different conversation that wasn't
Yeah,
recorded. So we have lots of avenues we could go
we do.
down. I guess
Yeah.
the first question is, I mean, you deal with this stuff all day, every day. What are some trends and specifically how how has COVID, now that we're maybe on the other side of the pandemic, I mean, COVID upset the apple cart on a lot of things 2 years ago. I
Yeah.
mean, how did COVID affect acquisitions of accounting and tax practices?
Well, it definitely changed the mindset of what a buyer believes they could possess in regards to geography, right? So it's how a firm is managed has changed, right? So it's, there's still definitively a large in-person, office, type of work, right? But there's also been this change where it's become more virtual, right? Where a firm can be managed more virtually. So I would say that it's changed the buyer profiles, that a buyer might look more nationally as opposed to locally, because they realize they can manage from a distance. But I would also say it's changed the market, is that I would say a lot of the baby boomer generation that was on the, sort of on the fence about selling has really probably come to the surface. And what we've referred to as the silver tsunami for a number of years, we've been waiting on these baby boomers to kind of make that first step of their succession plan, whatever that might be. I think that is finally, COVID probably was the precipice that triggered more deals to market. So it seems that the market might be shifting a little bit, right? It might be turning into what has always been a seller's market since I've been in the business for 15 years, is now finally, I think, starting to shift a little bit to a buyer's market.
I want to talk more about the silver tsunami that you mentioned, but before we get to that, I mean, let's just talk about some general things on tax and accounting practice sales. First, from the seller perspective, I know you help the buyer, but at the
Yeah.
same time, you have to look at what the
Yes.
buyer is buying. So, from
Right.
the standpoint of what you look at and what the SBA would look at, I mean, first, let's start with the more like micro solo operators, which is the
Yeah.
bucket I would fall under. I mean, less than 250. I know one
Yep.
time I contacted a broker about
Hmm.
potentially selling my practice, which is very small and doesn't even get to six figures in revenue. And he just kind of
Yeah.
laughed at me. He said, no one's even going to look at your book of business until you at least get to six figures of revenue. And really, he mentioned 250 as well. And that was
Yeah.
3 or 4 years ago. And
Yeah.
so if you're in that boat as kind of the micro operator, what are your options as far as potentially selling your practice besides just throwing your hands up in the air and shutting it down?
Well, it really comes down to structure. What's your expectation on the side of as a seller, right? So as long as you don't have the same expectation as a multi-million dollar firm where you anticipate that you're going to want a lot of cash at closing, it really comes down to how you're willing to structure the deal, right? So, Jason, if you were willing to merge your book into my book and then give me an earnout of say 20% revenues year over year for 5 years, I would probably take that deal because it's an easy, risk-free deal for me. Now, entering the open market, where there's a broker intermediary, you pay a fee, there's a commission for, you almost want to get to that, but like cash and closing multiple. And I'm not saying that's a hard and fast rule, right? There certainly might be somebody out there that wants to say you're doing 100,000 because that's an easy number just to work with. Say you're doing this right at the six figure, right? We say it's a 1-to-1 multiple. And if you were willing to say only take 20,000 cash up front, that deal is probably going to be a lot more tolerable than if you want all 100,000 at the closing table, right? So structure, I always say structure drives value. And that works across the board, whether it's a small deal or a large deal. The structure of a transaction can really change the marketability, right? The buyability. Yeah.
Okay. So that's your micro firm, but let's now advance it to you've met the 250 and beyond. So you have something
Yeah.
that's really saleable now.
Yes.
potentially it's
Yes.
saleable. What
That's correct.
really makes a practice attractive to a buyer and to a banker?
Yeah, well, it doesn't just apply to accounting, right? It doesn't just apply. This is not industry specific. This would be business economics 101, and it's cash flow, right? And so in this industry, right, we are all the experts of tax mitigation and avoiding tax obligations. And so, as professionals of that, you tend to see in these types of businesses where there's more tax mitigation than a non-accounting based business. So, I think one of the key elements that I always try to get out in the industry is that if you're looking to sell your business, any type of business, what makes a business valuable, right? And that's net income, operating income, margin, right? But it's critical element from a financing perspective. Historical cash flow is what we lend on. We're historical cash flow lenders. So I need to look back 3 years and see there's enough income dropping to the bottom line to support debt and support the person buying it. And if those two variables are there, then it really comes down to the individual themselves. And I always say that that's a 30-70 rule, right? 30% of the variables probably the individual, the buyer, how much money they have, what's their credit like, so what's their experience. But then 70% of the equation is the revenue of the business, right? It's does that business have an historical cash flow that can support the debt and support the person that's buying it?
So when you look at potential selling prices, you mentioned the ratio a little bit ago. I mean, I know I've
Yeah.
always read it's like 1 to 1 is typically what it is, but sometimes it's like 0.75 and sometimes it's 1.25, depending on the nature of the firm. I mean, what are the current here in 2022? What would be the current numbers to peg to on that?
Well, my portfolio is 180 million, close to 200 million in loans. And of the 5 years that we've been doing this, so we started the program in 2017, our average multiple over that time span was 1.15. So of all the firms of that 200 million that we've done, so that's where we can drive to a real statistic that's internal, that's numerical, that's been analyzed. So yeah, 1.15 is our number. I would say, if you talk to the broker world, they're going to tell you everything's 1.2 or 1.25. And then when you kind of get into what I would call the large firm acquisition earnout model, that's where it tends to, but again, I think structure drives multiple, right? Hopefully I can get a higher multiple on a more favorable structure, and I can, and then a lower multiple on a less favorable structure.
So you had mentioned some of the loan terms earlier, but if I'm a buyer coming to you and I have, say, a $250,000 firm that I'm looking at acquiring, or maybe let's say 100,000. I know you don't lend
Sure.
down to that low,
No,
but
that's okay.
let's use 100 just for
Yeah,
easy math.
sure.
So my acquisition cost could be like 115,000. Let's say. I mean, what would the terms on a loan like that need to be as far as like the down payment goes, and how you would structure something like that?
Well, this is a really cool feature about the SBA 7A program, is it allows there's two really neat paths to go down from an equity perspective, meaning that as a first time buyer, if you're coming from Deloitte or E&Y, you're coming out of private or public accounting, and you're wanting to buy a firm for the first time, you're going to need 10% down, right? You're going to have to put cash into the transaction to show that you've saved for this, that you have skin in the game. And so that requirement for the SBA is 10% equity injection. Now, if you're an existing firm owner like yourself, Jason, even with a smaller firm, again, still saying that 6 figure is probably the recognizable equity number. But kind of once you've laid down that foundation of having year over year cash flow yourself, right, and being able to operate your own small book of business, you can now leverage that book of business as your equity down payment. So an existing buyer, existing owner buying another firm, we can do that virtually no money down. I mean, limited money down, right? Because we leverage the equity in your existing firm into the transaction. Now, for a first-time buyer, again, great opportunity, because if you're buying cash flow, right? And so if you saved and you have that 10%, I would always recommend having the 10%, but then having a little more than that, right? Because the banks are going to want to see that you have a backstop capability, meaning we're going to give you working capital at closing, right? So you'll give us a down payment. We'll give the borrowing entity working capital to operate for the first 45 days. but there's going to want to be a little buffer that's be above all of that, right? That you still will have left kind of in your hopper. But yeah, is that a good, did I answer the question? Probably a
That's a
long
good.
way.
No, that's good. That's good. So what sorts of documentation do you need from the selling firm then? I mean, I'm guessing the financial statements are
Yeah.
probably the most important thing that you would
Yeah.
want.
Yeah. 3 years tax returns, a year-to-date P&L with balance sheet. That's really my majority of my due diligence as a lender, from a selling entity. Now, the buyer does have to, we do ask them to create a business plan and projections. And so there are things that are related to the future of the operation of the business. But again, we're a historical cash flow lender. So really the letter of intent, like what's the structure of your deal? How much cash? Is there seller participation? Is there any kind of retention modeling? And then, once we kind of figured out all those things, then it's just looking at the 3 years tax returns and year-to-date P&L, we'll be able to drive that multiple, right? And what the debt service on a 10-year term of that multiple would be. And then we can drive it into the cash flow of that business. And as long as, again, it sounds so simple, but it's really true. If there's enough left over to pay the debt and then pay the person that's buying the business, it's really 1.25 times, right? So let's say in that example, you had 50,000 in debt service and then employment, right? You'd want to see 75,000 in income, right? Or not even quite. Let's back that down. It would be, I don't know, like $60,000 in income on that 100,000. You'd want to see to be able to pay the debt and pay that person, right? So
Right.
we do have a minimum that we expect our accountants to make, though. We set that minimum at 75,000 annually. So that's where that smaller firm kind of breaks itself, right? Because there's just not enough money left over at the end of the day to support what we would call a standard living expense of an accountant, 75,000 a year.
Yep. And I think that we'll come back to that also for those of us who are small operators who look at how we're doing business and what the standards are for what you look at those numbers. An accountant makes 75,000 or 80,000 or whatever, even in a rural area. And it's like, well, now wait a minute, I don't make anywhere near that amount of money. So
yeah,
but
it's not, and it's arguable, right? We'll discuss making less than that, and that really depends. It depends on the individual, but that as a basic standard, we just like to assume that for your education, for your expertise, that you'd achieve that at least annually.
yeah. And so I guess the point is cash flow and showing net income in the business. It has to be a profitable book in order to, I mean, this is true not just of tax practice acquisitions, true of businesses in general. I run across a lot of business owners just in general who don't grasp the concept of cash flow. And, they're like, well, I'm going to go take out a loan and buy this piece of equipment for
Yes.
however much money. Well, how is that piece of equipment going to help you make money? And now
That's
you've
right.
got to pay that debt.
Yes.
And so I guess that, cash is king, as they say.
Mhm. Well, and we look at taxes as such a negative thing, but and they certainly no one's happy about it, right? But in mitigation, right? It's funny, you do everything you can to mitigate, right? And then when you have to pay the piper on that mitigation, which means you can't borrow money because you show a business that's not making any money, right? You want to be mad at the system, right? But it's like you didn't really feed into it. It's kind of like anything. You have to nurture it to receive from it, right? And so you really have to nurture a net income of your business, right, to create value, and that applies to all businesses, not just accounting tax practices. So
Right. So you've been doing this particular type of banking for the accounting acquisition side of things, you said, for 15 years now?
yeah, I was part of a specialty lending division of Bank of America that tried to do accounting, lending, and specialize in it and really compete with the SBA world. And then we found that the SBA was just able to take on more risk, meaning more loan to value. Conventionally banks aren't willing to, go that far uncollateralized, right, from a loan to value perspective. So we're getting beat by SBA, and I was like, well, I just got to go learn this SBA stuff, because I already found I found the industry. I should say the industry found me, and just fell in love with the people, right? The types of businesses. I will say I put myself in a favorable position because working with accountants is easy when it comes to being a banker, right? Because you don't have to fight their CPA for their for their information. They
Right.
generally have it.
That's true.
Yeah. So
So if we go back to 2007 or thereabouts, I mean, I think we touched on this some when we talked about the COVID trends, but really over the really long haul here of 15 years doing this, I mean,
yeah.
what trends have you noticed? How are things different now from they were in 2007, or are they different?
Well, no, they're much different. And this really comes to part of my mission, right? And the mission of the brokers that I work with in the broker world is that the accounting industry really, and there are people that are going to listen to this podcast and probably still think that the way that I talk about a transaction works is not normal or different, right? Or strange to them. But I would say in that time frame, the recognition of the value of an accounting firm has changed, and the ability to transition a firm from one owner to the next has become more well accepted and more lawful than ever before. Ownership, has changed. The type, the structure of a deal has changed significantly, Jason. Meaning that, 15 years ago, everything was an earnout. Everything was, no cash at closing. It was a percentage of revenue for a period of time. And really it was really a large firm message, right? The AICPA was driving down this large firm message of this is how a firm transitions. And what that was really leaving smaller firm owners left kind of holding the bag on was that the big firm or the bigger firm would buy them on an earn out model and then basically cherry pick their clients, right? Fire the low end clients that you worked hard to keep, right? That you still earned an income from. But those big firms really didn't have an interest in those small clients. But you did as an individual owner. And so what you found is that the industry was really the message in the industry for this large firm message is what I call it, was saying that there was not a value to be had at date of acquisition. And then banking came along and said, wait a second, we recognize there's value in these businesses. There's historical cash flow. There's evidently goodwill that is similar to any other professional services, dental, medical, veterinarian. So they're great. It's a great borrowing risk model, right? So, great financial management, advises other businesses how to manage their obligations, usually has, strong balance sheets. And so with that recognition, you saw that the industry has finally said, well, maybe there is room, and brokers really drove that. Intermediaries really drove that message too, as they said, we can get you cash at closing. You don't have to take a cherry pick earn out over a period of time. And so what I would say is it's leaps and bounds compared to where it was 15 years ago, is the amount of cash in transactions. And now you're even hearing at the AICPA Engage, you're hearing large firm consultants start to preach a message of cash, some cash at closing, whether that's in private equity is driving that now, because now that you have private equity sort of coming into the industry, doing these consolidations, they're pushing cash into the deal because they want, they have equity recognition that they want to put on the table right away. And so that's changing the way deals are done, is that there's just a greater recognition of value of these firms, and then lending cash into them and expecting cash for that value at closing.
So that old model of we'll give the seller. The buyer will give the seller 1/3 of the income this year, 1/3 next year, and 1/3 the next year, or 20% over 5 years or something.
Yeah.
That's kind of going away in favor of just here's cash right now, and I'm taking over this business now, and you get your money.
Well, talk about when you say it out loud, anybody with any economic background, we all have it, right? So if the average firm margin is 35%, right, or 40%, right? So a good practice has a 40% net operating margin, right? And we say we're going to pay you 20% for 5 years. So that means you're only leaving me with 20% as the buyer to do whether that's hire staff, marketing, add technology, change, and all that stuff is shifting and changing so quickly and rapidly that if you don't have the capital to kind of support that, you kind of get lost, in your manual filing system you're not able to jump onto the cloud. You're not able to do offshoring or, outsourcing. There's just all these things. Then the market's changing so rapidly that you need capital or cash flow to be able to make those changes. And so if you're stripping away 20%, half of my income, right, annually for 5 years, it really leaves me in a difficult situation. Here comes the bank, right, the SBA, and we'll say 10 years, right? Now we know we've chopped that in half, right? So now only 10% of our margin is going towards debt service. Now we've opened up an additional whole nother, and again, $1 million business, that's $100,000 a year annually to spend on staffing, marketing, digital technology, all those things that are critical to growing a business, growing a firm now in today's market. So
I mean, the market is, the market's changing, and now I want to come back to the silver tsunami because I feel like that ties in to what you just said about the changing market. And I'm in my 40s. It's hard to believe, but I am. And I've been doing this almost 15 years is when I started my practice. 15 years ago, I was by far the youngest person in any room, at least in my area. I'm in Iowa.
Yeah.
You walk into a room of accountants, everyone was older than me. Now, fast forward 15 years, everyone's still older than me. In a room of 25 people, there might be 1 or 2 people younger than me. And then there's me. And then there's people in their 60s. I've been in enrolled agent meetings where there have been people 80 years old shuffling in walkers. And it's great, I guess, that they're still trying to go. But where I'm going with this is what's going to happen with all of these, the gray hairs out there who probably are at retirement age. And I mean, a lot of them are small operators, so they may just shut down because it's not sellable. But certainly some of them have bigger practices. And I think that some of those, regardless of size, I think there's not a lot of exit strategy out there. People are just working and they're thinking about either retiring, shutting down. Maybe some of them are thinking about selling. But I get the impression, I don't know what your impression is, but my impression is that there's not a lot of thought given to really how am I going to get out of this?
No, there's and I think that's where kind of the broker world sort of filled that need that didn't exist before, is that there was a lot of accountants out there like, I don't know what to do next. I don't have a plan. There's not a junior that I can sell to. And that's really what you find, is that there's limited amount of junior associates, right? The thing about it, the market has to adjust, right? Just like it does with everything else. I look at you look at like the 90s, right? And when you talk about all the outsourcing that occurred once, once the internet was up and running, and how I used to work for American Express Small Business Solutions, and I ran a call center for a collection unit, and that got outsourced to India, right? They just said, we're going to take this call center that you're paying everybody $12 an hour, $14 an hour, whatever it might be. We're going to pay them $6, right? And then they make the difference. They still can facilitate. And so anyways, I tell that long story to say that, the market, the industry adjusted, right? Because of the technology and the changes. And that is where really what it is going to be, is that you're going to have the set of parts as a firm to make yourself onboardable, right? To make yourself, you can be kind of absorbed relatively easy because of technology. You're not location necessarily driven. You are cloud-based, those types of things. And what will happen is we'll have to see a consolidation of the industry, right? And then, because there's just not the accountants to buy the accountants, right? There's just not enough new accountants to buy all the old accountants. So what we need is new, fresh-minded accountants that use technology, use the things that are the tools that are available to them to handle more people, right? So it's today's accountant might only be able, maybe they're doing their 3,000 hours, or I don't know what it is, 2,000 hours, whatever that number might be, right? But it's not necessarily about billable hours anymore. It's more about how am I managing my team, right? To handle more work over a broader spectrum, and that might involve the Philippines, Mexico, India, where the labor exists, right? But but the management doesn't, right? You need the management here, right? But the labor can be elsewhere. There's not enough labor, right? We know that. There's not going to be. There's not like there's this group of people that are coming, right? The only solution is we have to look externally. And so what I think is you'll get fresh-minded individuals that will find the ability to recognize a way to roll these firms up into one, right? Manage them externally, meaning outside staffing wise, it'll probably be outsourced in some way, whether that could be AI too, right? Technology could change that too. It doesn't necessarily have to be a different labor market. The technology is shifting so rapidly too that there's, we're starting to see some human touch in that technology. It's exciting, really, and I think that there's an exciting opportunity for that fresh-minded young entrepreneur that has that roll-up capacity. I'm the guy that's willing to put money behind it, right, to capitalize those roll-ups. That is really the unfortunate. The only solution I see, I would say, if you're a rural firm and you're still manually using a number 2 pencil, right? There's no way that firm can be onboarded anyway, right? You have to join the team here, join team technology, right? Go cloud-based, get your clients used to onboarding electronically, right? And interacting electronically so that someone at some point can take your rural firm and manage it from New York City, right? Manage it from, Charlotte, North Carolina, right? And there's solutions. You just have to build your firm in a way that can be received well in the industry, I guess is the best way to say it.
And so, I mean, like with that rural firm that's doing everything manually, they're not really in the cloud. And I encountered, it was a law firm that does tax work, and they had taken on one of my clients. Actually, it's a long story. They needed
Yeah.
her prior year tax return. And
Yeah.
I mean, getting that return to them. I mean, this was this guy, he's 75 years old.
Uh-huh.
And I had to snail mail a
Yeah.
55-page tax return to him because that was the only option that
That
he
he would
had.
receive.
Yeah,
Yeah.
and I'm guessing if we tie it back to what you do, I mean,
Yes.
it probably wouldn't ever even reach you because there's no modern day buyer who would even be
Right.
interested in taking on a firm like that, I'm
That's
guessing.
correct. That's correct. Yeah. I mean, if you think about how that firm's managed, it's physically that practitioner shows up every day in that location in nowhere, Arkansas, right? Hypothetically. And the only way that firm can be managed is if someone can show up in nowhere, Arkansas. Well, guess what? There's nobody's in nowhere, Arkansas. So it's no offense to nowhere, Arkansas, but but that owner has they're in this precipice moment, right? Where they can functionally take that client and shift them to a technologically savvy client. And it's not really that they're technologically savvy. You showed them how to take a picture with their phone of a document, right? I mean, and scan it and email it to me, or, maybe you've provided them with some sort of scanning operation. I'm not sure what that might look like. Whatever makes it easiest. That's not my specialty, but I recognize enough being in the industry that that shift has to occur, right? Especially, I think, as that existing firm owner in nowhere, Arkansas, you have an obligation to your client to give them the ability to onboard themselves at a later date when you're not able to, right? Because what's going to happen, right? If you close your office, they're going to shift to the H&R Block at Walmart, right? And they're going to walk right into that Walmart, and that person in that Walmart is probably not going to do those taxes. They're going to scan that information into the system, right? And send them on their way electronically anyway, right? So teach them, be innovative, be cutting edge, be, just, if anything, be current, right? Just be current. Just join the revolution.
Right. Well, and this observation ties in again with what we're talking about today. Now, some of this seems a little off topic, but it's not, because it all ties back into whether you have something that you could sell or that someone wants to buy that you would be interested in lending money to buy for it.
Yeah.
I just see, it's a big problem in this industry, the aging and the fact that there's no transition plan for so many people. And smaller operators like me are throwing their hands up in the air and quitting. And
Hmm.
bigger firms, even medium-sized firms, are saying, well, we're not really doing 1040 work anymore.
No.
Or
Yeah.
we'll do 1040 work, but only if you sign up for our advisory track and pay us $3,000 a year.
Here.
Or
Right.
we'll prepare the tax return for the local corner store, but only if you're on a business advisory track, paying us
Right.
probably 5, 6, 7, 8,000 a year. And your average person, I know because I've tried to do the advisory
Yeah.
track with my small practice, dealing with your Mr. and Mrs. Jones and
Yep.
your local Main Street S corporation. They don't
Yeah.
want to pay you $5,000 a year for
No.
advisory services.
No.
And what's happening is these bigger firms, that's the only option. Even
Yep.
medium-sized firms, that's the only option. Lots of small operators are either throwing their hands up in the air and walking away, or, no joke, those 70-something-year-old practitioners are seriously dying at their desk. Even sometimes I picked up clients where they're like, well, my old guy, he died, and so I need someone to do my taxes now. And
Yeah.
you have all these average folks, they're being pushed down, down, down because they can't go up to the bigger firms because the bigger firms don't want them.
Yeah.
And there's not as many small practitioners. So people like me get overwhelmed,
Yeah.
which leads to either turning people away or more burnout and frustration, and more small operators just shutting down. So there's less and less smaller average firms for people to turn to. And then
Yeah.
you're left with going to the Walmart chop shop, where at our
Yeah.
Walmart there's some guy sitting at, it's almost like a school desk in front of the
Literally.
cash registers. And
Yeah.
so it's like,
He's only
where are
there.
all
He's only there for 90 days too, right? He's
right,
just
exactly,
disappears in
yeah,
May.
right. And it's like, is that really where these people are going to be forced to go, your average person? And so
Yeah.
I mean, and that all ties back to the sellability of firms, and processes and procedures, and I guess thinking about things. I mean, it all ties back in
It's
really to
all, yeah.
potentially selling your practice.
Yeah. And look, I think you can still have a successful 1040 firm that's valuable in the market, right? I think that location drives that a lot, right? Your the viability. There's still many buyers for those types of firms. And those types of firms still sell, and there's still value in a large 1040 firm. But then it comes down to location, right? So it's like in Charlotte, that's easy, right? In New York, that's easy. In nowhere, Arkansas, it's not easy. There's just not they probably have the same problem with who the next sheriff's going to be, or who the next barber's going to be, right? If those towns are dying, and it's just going to be hard to find. And so the best thing we can do is really find a way to service those clients, to train them up so that they're able to be transitioned into an easy technological onboarding process, right? I really can't. I mean, if you're not trying to get to the cloud, you probably are going to die at your desk. I mean,
Yeah.
that's really what it's coming down to. So,
Well, and I'm in a rural area myself. Well, sort of. I'm near Des Moines, Iowa, but there's
uh-huh.
cornfields between Des Moines and where I'm at, of about 10 miles of cornfields. And it's hard because I have a lot of older practitioners who have come to me
Sure.
and said, well, I could just give you my book of business, even,
Uh-huh.
100
Yeah.
clients or whatever. But it's like,
Sure.
how am I going to, you've got to be able to service that, is the
Yes.
problem. And so if you're that smaller practitioner trying to get to like that 250 gross
Yeah.
revenue threshold,
Yeah.
that's nice to say, acquire
No.
another practice or another book, but how am I going to service that book of business? Because I know some younger,
Yeah.
like, CPAs that I could potentially hire, but
Hmm.
they don't even work at CPA firms. They work in like industry. And
Yeah.
there's no way that I could even come close to offering the kind of compensation they get.
Right.
And
Right.
then, what I told my wife this last tax season, I said, why would anybody want to do this? And that's a terrible thing to say. But, when you're working 70, 80, 90 hours
Yeah.
a week during
Yeah.
tax season, and there's no break anymore, it never stops like it used to.
No.
April
Right.
15th is not the stopping point
No.
anymore.
No.
And
Yeah.
so it's a lot less palatable to work 90 hours a week. It's like, who would want
Yeah,
to do this? How could I go to someone
right.
with a straight face and say, "Well, come work for me,
Yeah,
and you'll have to work 70 hours a week during tax season, and then probably 40 hours a week every week after that. You have no real break, and you're working
yeah.
way more
Well, and
than 40
so
hours a week." So
I mean, the one thing that the variable there that has to change, Jason, is how the work is accomplished, right? Because
right,
it's impossible for you to you even if you wanted to, you couldn't, right? It's so you've already maximized your hours per week that you can work, and there's only so much humanly possible, right? And so we have to, and really, Molly, it's going to be technology, right? AI hopefully can shift with some recognition and some, automatic categorization and placement capacity, hopefully, and then it just becomes a reviewer. You become a reviewer of the AI's work rather than an actual doer, or outsourcing, right? It's, labor's cheaper in other countries. A lot of them are becoming better, better English speaking. A lot of the data can be shared in a secure fashion that there's not a recognition of whom it might be or a loss of private information. So what choice do we have, right? Because you can't continue. The definition of insanity is do the same thing, expect different results, right? And we can't continue to operate that way, right? And expect
right.
it to change. It's only going to get worse, right? Because the mountain just keeps getting bigger, right? And so we have to find ways to mine it, right? Work it smarter, not harder.
So I guess as we start to wind this down, I mean, the point is there's opportunity for people like of any age, but my age or younger who may be entrepreneurial minded, want to grow a firm. I mean, it seems like there's a bigger opportunity maybe than ever before for someone who really wants to go get it.
Mhm.
There's opportunity out there
Yeah.
to do exactly that.
Well, I'll give an example. You as an example, right? You could take, let's get your firm up to $100,000, right? Because that's where we call the equity value, right? But then we leverage that $100,000 firm into, say, a $400,000 firm, right? You've just quadrupled. Didn't really you use that $100,000 as your kind of your down payment into the 400,000 model, right? And then you manage that, you bring it on board, and now you have a $500,000 firm. Now we can leverage that $500,000 firm, give it 18 months, right? And then stack another $500,000 firm on top of it, right? And then $1 million firm on top of it, and then $1 million firm on top of that, and then a $3 million firm on top of that. And then private equity is knocking on your door and saying, we'll give you, 6 times SDE or 10 times EBITDA, right? For your, for this automated accounting machine you've got here. And that's the key. Automated accounting machine, right? You have to find the technology and the systematic ways, but the opportunities are with the silver tsunami, right? And the equity leverage variable, you can do a roll up in a matter of a short period of time. You could build I call it wealth building through debt, right?
Mhm.
Because that equity position on that $5 million firm, right? Even at a 1-to-1, right? It's 5 million, right? So yeah, if you are entrepreneurial, it's a very exciting time. Very
That
exciting time.
almost sounds, Shannon, like rich dad, poor dad sort of leverage, and use that good debt to
Yeah,
purchase income producing assets. I mean,
that's
that's
right.
that's really what you have to do. And if you're willing to
Yeah,
go get it, and I always find the hard part is pushing past that, it's debt. I've got to pay
yeah,
cash for this. If I've got to buy
yeah,
a book of business, I better have 250,000 to
yeah.
pay out. But
No,
that's not how you really grow and leverage. That's not really getting off track, because
well,
that's
no,
exactly what you were just talking about, is you're
that's
stacking
right.
it, and you're
Yeah.
leveraging
Well,
the
well,
equity.
let's talk about a real life factual figure today. If you borrowed $1 million 3 years ago, right, at 5% or 5.5%, whatever the rate was at 3 years ago, right, that $1 million 3 years ago, it's exponentially worth so much more just because of inflation, right? And so you bought if inflation was 9% like last quarter, right? If you're borrowing at 5, you're winning just on inflation
Right.
alone.
Right.
just on flat. I mean, let's not bring all the other variables into it, like actual cash, right? All the benefit you get of the ownership and tax mitigation and so on and
Right.
so forth. Yeah.
Well, and
Uh,
the bigger you get, I think the more you could drive the higher fees, and you could do what a lot of the bigger firms are doing. Like I talked before, like, well, if we're going to work together, you've got to be on an advisory model, and
yeah.
you're paying
Yeah.
several $1,000s a year, not $200 to slap together your tax return. And
Right.
suddenly your revenue just increases so much more because you have that kind of clout with your clients. You reach a
Yeah.
certain size where you could just behave
Yeah.
in a different way toward your clients and what you expect from them and what they pay you. So your revenue goes up, and then that just continues to feed the value of your firm.
A weird thing that's occurred in the accounting industry, and this is in the last 5 years, I've really noticed, is that there's this big turnaway of clients. Like it's not majority of firms I talk to are not even accepting new clients. Like it's like
Right.
we're selling just, and it's like, well, are you taking on new client? We haven't taken on new work in 3 years. It's like, what do you mean? It's like, well, we don't have the
Right.
capacity. And the new work we get organically just through our existing clients outweighs any work we can take on externally. So we just stopped taking it. And it's like, but if you had that management, that ability, right, to offload in different places and take some of that, just the ability to take on new work. If people can learn to do that, I think that, the organic growth probably would be astronomical too, once you have that foundational, word of mouth base, I guess maybe is the best way to say it.
So if someone was listening to this and they're interested in more about maybe moving down the road of buying a practice,
Yeah.
and they're interested in what you could do for them, I mean, what would be a good next step for a person?
Yeah, well, you can always email me. I'm pretty responsive with emails, or and as well call me. I get the claim of the banker that answers their phone. So my cell is 614-648-9199. My email is shannon.hay@liveoak.bank. And then I'm also on Twitter at Shannon Hay LOB, and LinkedIn.
Excellent. Well, all right, Shannon, is there anything else? And you can say no to this, and that's fine. But is there anything else that we need to talk about? Anything else you want to say that hasn't been
Yeah.
brought up that I haven't
Well,
asked?
no, first and foremost, Jason, grateful for you for, having this conversation, bringing this topic to light, give me the opportunity to talk about it. You could probably tell I'm passionate about what I do. I love helping people realize their dreams of ownership and entrepreneurism. Please, I mean that with all sincerity. It's help, right? I want to help. So use my help.
All right, that's Shannon Hay with Live Oak Bank. And thanks so much for joining us, Shannon. I'm sure we'll talk to you again some other time.
I hope so, Jason. Thank you so much.
All right, John, I think we got another episode in the books.
Thanks, Jason.
Shannon. You
All right,
bet.
buddy. See you
Bye.
soon.
Bye.
All right, man. Bye.